Hi, Larry Gaines, PowerCycleTrading.com. In this video, I'm going to show you a directional trade that we set up today, and this was an alert trade sent out to our trade alert service. Now, this is a trade based on every trade that I look at or take before ever the execution of the trade is ever taken. I go through a 7-step directional trading profits formula, and one of the key steps is what we call using price target analysis. So, step 2 you can see is kind of the directional trade entry that's based on our trading model, and then step 3 is I always look to establish profit targets for the trade. So, where can the trade go as far as potential profits? And that's based on what I use as Fibonacci price target mapping, expected move, some other things. But what this does is establishes really good firm profit targets, and then we can analyze the trade based on that target to look at the risk reward. So on this trade setup, this is a trade that we did today on Etsy. So let's walk through the trade. So Etsy has been in this really kind of a consolidation phase ever since early part of May. So about 2 months. And then you see these dots. That represents what we call a volatility compression squeeze with the potential breakout that can be pretty explosive either up or down. And we've got our momentum cycle 1 and 2 pointing up, so that gives us the probability of direction to the upside. Now, after I kind of map this out using Fibonacci, some other things that I use within this kind of what I call price target mapping, our first target's right about here, 181, 180. So we set up a trade using what we call a calendar spread targeting 180. And so what this does is when I have a lot of resistance, we can target it and we can get paid a lot of premium if we get the right conditions. So this is the trade setup that we did using a calendar spread on Etsy. So one of the important parts of a calendar spread, one big component, is implied volatility. So when I see an implied volatility like this is what we call skew, positive horizontal skew. You can see the 25 June series right here, 3 days to expiration, has a 51.92 implied volatility. And then you look back to the back months, the further out, longer dated, like for example the 23 July here, 31 days expiration, it has an implied volatility of 45. So what we want to do, take advantage of that, is by selling this front like the 25 series short and buying the 23 series long, and that creates a calendar. So we get this relative higher value from this implied volatility, plus we get the theta differential from higher theta decay in this front month, our front series versus the back. So we get that double kind of extra edge on the trade. So here's what that trade looked like. So we did this as a spread today. This was an alert trade sent out. So bought the 23 July 180 call, and at the same time sold the 25 June 180. We did it for a total debit cost of $520 per spread. So one spread, $520. Now here's where it was today going out. So we had a profit going out about 46, and a big part of the trade is right here. See the theta right here? It says 27. So this is a very positive big theta kind of driven trade. So every day right now, tomorrow we would gain another $27. So you can see if I put my date here to tomorrow, this is up to $73. Now look here. Now we've got the theta is increasing. We've got like 34. So you can see then on the 24th right here, we're going to be up 107. Now, if we get into our short strike, this is this Friday, the 25th right here, and it's trading at right here. This will be up $153 if it's trading at 178. But if it's trading at our short strike of 180, we'll be up about 170 in the morning, and at expiration that day, this Friday, it could be up to $300 or greater. Now, the other really great thing about this trade is if we don't get to 180 and it closes below 180, we get to keep this premium from the short side, the 25 June, the 180 strike here. We brought in $185. So we have the option then this Friday, if it's not trading at 180 and it's trading below, we keep that 185. That adjusts down our cost of the long dated, and then we can turn around and sell another 180 or higher for next week. So it's a beautiful trade setup. We take advantage of high implied volatility in that front part of the spread. Plus we get this big fat theta, and we have potential to adjust this for a bigger breakout trade if we'd like. So if you'd like to learn more about these types of option trades, directional trading, price target mapping, make sure to join us at PowerCycleTrading.com. Good luck trading.